Hello, everyone, and welcome to BFW 2401. This is part one of week 7. In this part, we will talk about the type of loans and some modeling for credit risk. So let me share, and we just go to the slides. So this is the slides, and actually this week is we are talking about chapter 10 and 11 in the book. This is the learning objective, and actually what we want to do is trying to understand the importance of credit quality. And we will be talking about the type of loans. Now, the types of loans, as we talked about the types of liabilities on week 6, now we are talking about the types of loans here, and there are some categories. We will not go in details because loans and liabilities is actually type of financial products. And our concentration here is not the financial products, but actually the risks. We will understand the business loans, talk a little bit about the housing loans, personal loans. But the most important thing when we start talking here on the risk, we will touch on the price, how we price and how much interest we should charge our customer and what is the best to charge and what are the modeling that are actually involved in this process. Then we will go to the measurement of the risk, and we are talking about measurement, which would help us to define which will help us with the selection risk. When we measure it, we know we can put some type of benchmark, and in that benchmark, we will see whether we can accept or select the customer, which is the business firm or no. We will talk also when we talk about when we divide this measurement to qualitative models and quantitative models. We will understand a little bit about the credit scoring. Credit scoring, I talked about it in this additional slide, which I already provided to you. It's a recording, you can look at it and how does it work. But here we talk about credit scoring for firms. And then later on, we will start to talk about new models that are based on financial theory. So let's go to the importance of lending. So loans are very important in any financial, in any what you call balance sheet for any bank. In Australia, it's 70%. In this country, it's 70% of total assets actually going from the loans. Managing the loans and credit risk is very important to the bank because that will keep the bank survive. All the financial crises we have seen involve actually credit risk. Lending is an important contributor to the bank profits. It also creates a key risk, which we call it a credit risk. Lending also very important for the economy and the and local economy and world economy actually, because of this integrations on the systems, you can borrow and lend to anywhere in the world and inside the country. When we talk about credit risk, for sure, we remember the recent subprime problems, which we have talked about it, which was a credit risk. Credit risk control is also because of this contagion phenomena that goes from one country to other country and from one bank to other bank because of the integrations, especially when we talk about big banks. So it's actually a concern when it comes to, it was a factor in the global financial crisis, and it's a concern in this issue. I think we have talked about the trading book and banking book before. But so as you see, lending and loans are actually part of the banking book. A banking book is that, it contains those assets that will continue until it matures. And this is what happens with the loans. They continue with the bank during their life, unless, of course, you sell them. But the normal process and the normal course is to keep them until they mature. And this is why they are in the banking book. This is the type of loans. We have commercial and industrial loans. This is for commercial and manufacturing companies. You can have secured and unsecured. Secured when you have collateral. And then when you come and break them down, you have syndication loans, which means syndication, I think we have talked about that. Syndication loan basically means when we have a loan, but with a group of banks, for example, a huge bank, a huge loan, then that loan can be given by so many banks where they can make what we call a syndication and give to a customer. And I think I have explained this when we talked about Tencent Corporation in China, the owner of WeChat and QQ. This have been taken a huge loan in 2016 and 17 from a group of American and European banks. We have something called spot loan. This is another classifications, which you give the loan after you sign the contract, or we can promise to give the loan later on, which we call it loan commitment. Now, there has been, because of this improvements and development of the financial systems, there has been a decline actually in the commercial and the industrial loans. And companies now, they don't go and take loans from the banks, but actually they go to the market and they borrow from the market. So when the systems, when the financial system in any country develops and the stock markets and the financial market improves, the depositors, instead of being a depositor, they go in the market and they become an investors where they start to buy stocks and bonds or whatever, and the rest of those financial securities. And the borrowers is becoming issuers, so they go and issue. This is why we say decline is becoming, this declining is becoming because of the development of the financial system and the capital markets. We have also the real estate loans, primarily the mortgages, and we can have some of them are fixed rate mortgages. And we can have adjustable ones. We call it ARM, and most of the loans are actually adjustable because they link it to the basic lending rate. And we have mortgages can be subject to default risk. I mean, mortgages can be subject to default risk when loan to value increases. And this is an issue we will discuss it later. But the loan to the value, for example, if we buy a house and the house is 1 million ringgit, and now mortgages can, you can give, for example, 50% of that loan, so the risk will be less. But if you give, for example, 1 million of the loan, which is 100% or 95% of it, then actually that will increase your defaulting. So the less is the loan to the value. So if you give a loan for a house of 1 million, you give 50%, your credit risk will be less. We have also what you call consumer loans. And this, we know it. We talk about any personal loans, like credit cards, like auto, which is automobiles loans, and other personal loans. And we have also another classification called revolving loans. And this is like the credit card debts. So the credit card debts, you sign only one contract when you take the credit card. And when the statement comes, for example, you start to borrow during the month, which is according to your spending. When your income comes, like the paycheck, whatever, you clear the statement and then you start again taking a loan. So that loan is actually revolving, which means it comes, they top it up for you when you pay. So you don't have to sign another contract. This is where the word revolving, where this term called revolving comes to the picture. And we have something called non-revolving loans, which is a loan for one time. When it ends, you have to have a new contract and take it. And this is what we call like automobiles and personal loans and other loans. And of course, the government can, ask banks to give loans to some sectors that are actually disadvantaged in the system, and they want to encourage them, like farm loans, interbank loan, like farm loans. And also we have something called interbank loans and government loans. This is all type of loans, and I am not going to extend beyond this one because we are not actually talking about the loans, but the risk, the credit risk. So this is the type of the loans, just in terms of description. This is where we start with the most important issue, which means the pricing. How can we price? So we have two things. One of them called the contractual promised loan. Now, the contractual promised loan, what about it? The contractual promised loan, which is this one, and we have another one called the expected return. Now, let's go first to the what we call contractual one. And this is when you sign the contract to the customer and you tell him we are charging you such and such interest. So it's a combination. It's governed by this formula. And I want you to know this formula very well. So if you have $1, this is $1 given to the customer, you receive from the customer end of the year K, which is the return. So this 1 and K is actually the principal plus the interest. Now, what is the principal? This is actually the this formula is the breakdown of the this contractual promise loan. This is the $1, as I told you, the loan. This is what you have to pay. And the K, the breakdown of the K is this formula. So you have the fee, they charge fee with the loan all during the life. And this is why we see interest rate is going up with the fees. This is the part of the fees that is incorporated in the rate you are given. So when you pay, actually you are not paying only the interest, but paying also some fees. And then you have the basic rate, which is the overnight rate, which is coming from the free, what you call it, free risk rate. And then this is the premium you put. This is what you should charge, but then it can be inflated because we take something called compensation balance. Now, this compensation balance may be a new term for you, which I want you to know, and also the R, which is the reserve. Now, let me come to here and tell you what is a compensation balance. It's a minimum deposit that must be maintained in the bank account by the borrower. How does it work? For example, if the bank give you 1 million a loan, they expect you, for example, if the compensation balance is 10%, they expect you to deposit 100,000. So, and that will stay with the bank. That, of course, will decrease their risk in the future. But most importantly, actually, they charge you a rate for 1 million while you have a deposit of 100,000, which actually they don't pay you anything for that. And this is what we call it compensation balance. And banks do that. It could be 5%, it could be 10%, but when it becomes more, the effective rate will increase in you. Now, the reserve is what? The reserve is what in Malaysia we call it SRR. This was 4% before. Out of each dollar you receive, you have to pay. In this country now, after the COVID comes, they just decrease it to 2%. So this also you have to pass it over to the customer because you are not using the whole deposit amount of the $1 that has been deposited, and this you pass it also as a cost to the customer. Now, if you look at this, then this is actually, this part is actually the breakdown of the K. And you can see when the reserve increases, the K will increase. When the P increases, which is the compensation balance, this one will increase. Now, this is one issue. The other issue is, are we going to get the contractual? Of course, no. And therefore, we have another term called the expected. And the expected is we take the expected R, which is the probability of payments, how much we expect all our loans to pay, maybe 95% of them will be paid, 97, 99. And then we bring the principal, because if the customer default, they will default in their interest and their principal. So this is actually what the bank will receive, which is the principal, the probability of payment times the $1 they receive plus the K, which is coming from here. And this is how we measure the expected return. Now, that's what I want to talk about in this slide. And actually, it's a very important slide. And I want you just to know how to calculate the contractual and the expected and the relationship between them. There is a big relationship because we have introduced now something called the probability of payments, which means this is how much we expect to receive from our loan portfolio. It depends on your credit quality, but the higher is the better, the lower is the worse. Now, let me come here and give you an example to calculate the expected return, the contractual return. So if the basic rate is 12%, and the fees and the premium is 2%, and assume you have 12.5 basis point of fees, and compensation balance, which I told you 10%. So if you take a loan of 1 million, you have to deposit 100,000. And then if the reserve is 10%, if you calculate it, you will find that actually you are paying 15.25. This is the formula. This is just the formula. This is just the formula, this formula. I didn't do anything. It's this formula. I calculated also, they tell you they are charging only, for example, the nominal rate, which is the fees plus the BR plus the M, which is in this case, the 12 plus the 2 plus the 50 basis point. When you take this to calculation, it becomes actually 15.25, as you can see. Which is have been inflated. Now, if you look here, when we talk about the rate, when we talk about the expected return, assuming that our probability of payment is 95. If the probability of payment is 95, look, the rate has been dropped from 15.25 to actually 9.48%. This is the return to the bank. And why is this drop? Because the 5% is not only from the interest, it's actually from the principal and the interest. This is why we see this huge drop. So when the probability of payment drops for a customer, it's very risky, or for our portfolio, it's very risky because it dropped the return highly. Now, one more thing before I leave also this slide is how much we should charge. Now, we want to charge in this point. And why we want to charge in this point? Because this is the rate. You can charge 1%, 2%, this is when you price, 3%, 5, 7, until you reach to 15. So a normal thing would say, well, the customer needs the loan and I can give him the loan, and because he is under stress or he needs that loan, I can charge him 15% and he will sign the contract. But actually, if you look at this, this is the defaulting. This is the probability of payment, which is this formula, which is the expected return, which is the expected return. This is the expected return here. As you can see, the formula is here. So if you have to be careful in how much you charge. And actually, your pricing policy should bring you to this area where you can get the most expected return. Here, you will keep increasing. That will increase it, increase it, increase it, until you reach to a point here. If you extend and increase the return, then you expect more defaulting. So the probability of payment here will drop and will decrease, and your expected rate of return will also drop. So you have to understand this graph from this perspective. It's so in this case, the best way you can charge is actually 8%. This is the second technical point. Let me go now to the, this is just an easy issue. When we try to control the risk, we have two types of customers. We have the wholesales, which is the businesses, and we have the retail, which is the personal. Now, if you want to decrease the credit risk and keep the relationship also with the customer, you don't reject them, but you can, for the wholesale, you can increase, you can use the interest rate. So when they come to take new loans, more and more loans, then you increase the interest rate. And if you increase the interest rate, the action from the wholesaler will say, no, I don't want it. I don't want more loans because it's already expensive for me, because they know they have this, they can analyze and they have rate of return and they can calculate it. So you can use this way, they will react. And you can also use another way, which is when their leverage had reached to a certain point, and the number of loans taken from your bank is reach to a certain point, you stop lending to them until they, started to clear the old loans, and they can give them another loans. So we use two ways with wholesale customer, which is the business customer. We can increase the interest rate. We increase the interest rate in the same time we decrease also the quantities of loan giving to this customer. How about the retail, like me and you? If we go and take credit cards, and tomorrow we want a car, loan, and they will give us. Later on, we want to go for tourism and we travel out of the country. We want another loan. So if the bank tell me the next loan will be 50%, most retailer will say, okay, sorry. Most retailer will say, yes, I will take it, no problem. And therefore, we use with them only the credit quantities. So we don't increase, we give a retailer a loan, and then we don't increase, the quantity of loans. And this is a way to decrease, to control credit risk with these two types. That's the whole thing in this slide. Now, let me come to the models.